SpaceX's record-breaking IPO is colliding with a higher-for-longer rate regime, and that clash is now shaping the tone across global equities. You are watching vTalkInsight, Equity Pulse Daily for June 15, 2026. We will unpack how a powerful AI and space-driven risk rally is meeting central bank discipline, bond market fragility, and stretched valuations, and what that mix could mean for equity leadership and volatility in the weeks ahead. The macro backdrop today is a tug-of-war between persistent policy tightening and a temporary easing of the energy shock. On the policy side, the Federal Reserve is expected to remove this year's projected rate cut and scale back next year's, signaling a higher-for-longer stance, while some see the risk that 3 hikes from December are still underpriced. In Europe, the European Central Bank has already restarted hiking as inflation broadens beyond energy, and officials continue to describe July as a live meeting with more than 2 additional moves still on the table. The dilemma is that growth and demand look fragile, so every extra hike increases the risk of a later policy reversal and eventual rate cuts if the economy slows more sharply than expected. Against that backdrop, term premia in major government bond markets are described as unusually compressed just as issuance ramps up, particularly through a heavy June calendar. At the same time, the U.S. fiscal deficit is widening, a larger share of the budget is going to interest payments, and fixed income specialists remain broadly bearish, warning that longer-dated yields may need to rise to compensate for supply and fiscal risk. Energy and geopolitics are giving markets a short-term reprieve. Hopes for a U.S.-Iran understanding to reopen the Strait of Hormuz have knocked Brent and WTI down roughly 3 to 4.5%, with European gas prices falling even more and European government bond yields moving lower as inflation fears tied to Hormuz ebb. However, physical oil signals remain tight, with Cushing inventories well below their 5-year average and refined products like jet fuel and diesel in Europe trading at very elevated levels, while clearing mines in the Strait could take months. Gold is still favored as a hedge. Correlations between equities, treasuries, and gold are rising, and over the past week the S&P 500 has swung from losses of more than 2.5% to gains close to 2% as the VIX drifts back into the high teens. The macro floor is therefore unstable even as risk appetite improves, putting a premium on upcoming Fed and ECB communication and on the path of oil around any Iran deal. On the equity side, price action has turned broadly risk-on as energy fears ease. Global equities are rallying, with Asia up close to 3% and Europe opening strongly on optimism around a potential Iran deal and lower oil, while U.S. stocks extend gains after last week's rebound. Underpinning that resilience is a powerful earnings story. S&P 500 earnings growth in the first quarter ran near 28%, well above historical norms, and while price-earnings multiples are high, they are not being described as extreme given the earnings base, suggesting a robust rather than purely speculative valuation backdrop. Leadership is still tech-heavy, but there are early signs of broadening. The Russell 2000 has outperformed with roughly a 4% weekly gain, and commentary points to an expectation that small caps and companies tied to the space infrastructure build-out could take more of the baton over the next year, even as the market remains heavily dependent on a narrow group of high-earning tech winners. Sector moves reflect this rotation. Energy stocks have underperformed as oil and even long-dated contracts fell more than 4% and European gas dropped over 7%, leaving the European energy sector down around 2.5%, while travel and leisure names, especially airlines such as Ryanair, are rallying on lower fuel costs, and banks like Banco Santander are supported by falling European yields and a friendlier risk backdrop. Positioning data suggests the market is not excessively long, with systematic and discretionary risk indicators near their medians and sentiment surveys showing only modest optimism, even though some strategists argue that staying neutral on equities carries an opportunity cost in a structurally higher nominal growth and inflation world. At the same time, passive funds are still pulling in around $80 billion a month in the U.S., which should help absorb a projected $250 to $300 billion of global IPO supply in the second half, but there are concerns that the surge in mega-cap offerings and equity raises could create 6 to 9 months of valuation indigestion and raise correlations between equities, credit, and traditional hedges. The heart of the current equity story remains the AI and semiconductor complex. Chip stocks have surged roughly 12%, helping drive a more than 3% rally in the Nasdaq 100, and earnings revisions for Nasdaq names and semiconductors have been exceptionally strong since March, leaving investors reluctant to rotate away despite elevated valuations. Company moves reinforce that strength. Infineon is committing about €5 billion to a new semiconductor plant, supported by European Union chip funding and strong demand for power electronics, while Citi's upgrade of AMD on confidence in its AI chip roadmap and potential business with Meta shows how quickly perceived winners can gain incremental capital when their AI narrative strengthens. Behind these stock moves sits a massive AI infrastructure investment wave, estimated at around $800 billion this year and more than $1 trillion next year. That spend, combined with bottlenecks in GPUs and advanced semiconductors, is pushing up producer prices and starting to filter into consumer prices, adding a new inflation pressure that offsets the longer-term promise of productivity gains. Hyperscalers have responded by sharply increasing bond issuance to fund capex, and fixed-income investors appear comfortable with current yields and tight credit spreads, suggesting strong demand for the new paper but also intensifying competition for liquidity. Legacy memory and storage companies are regaining relevance as data center demand soars, yet their valuations now hinge on AI capex staying elevated, and history shows that accounting dynamics and tech cycles can inflate earnings for suppliers such as Nvidia on the way up, but leave them exposed to abrupt downgrades if order books contract. As a result, the current AI-driven capex boom, which is already larger than the late 90s TMT build-out, offers both substantial short-term earnings power and the risk of sharp reversals. Concentration in AI-related equities and corporate credit is increasing, raising correlations across asset classes and making traditional diversification less reliable. So monitoring capex guidance, GPU pricing, and any shift in credit spreads will be critical for judging how durable this phase of the equity cycle really is. The most visible expression of today's risk appetite is the SpaceX IPO, which has become a defining event for both AI and space-exposed equities. The company raised around $75 billion in the largest listing in Wall Street history, priced at $135 per share, and early trading lifted the market value toward the $2 trillion mark, leaving roughly $20 billion of upside on the table for first-day buyers. Demand has been extraordinary, with the deal reportedly 4 to 5 times oversubscribed, institutional and retail orders well in excess of $100 billion, and nearly 500 million shares changing hands on day one. Even though the retail allocation was cut to around 20%, enthusiasm was strong enough to cause platform disruptions, and ETF providers have rushed to file more than 20 SpaceX-linked products, including leveraged and inverse strategies, turning the stock into a liquid proxy for the broader space and innovation theme. Fundamentally, SpaceX combines dominant launch market share, with about 90% of global payload tonnage, and a rapidly expanding Starlink connectivity business serving around 10 million customers, with an aggressive push into AI hyperscale compute. Recent deals with firms like Anthropic and Google, alongside plans for its NeoCloud infrastructure and the pending acquisition of Cursor, have shifted the narrative from pure aerospace to a diversified AI and data center platform, with some forecasts now suggesting AI-related revenues could exceed connectivity by 2028. Yet the valuation and structure are generating intense debate. SpaceX is trading at sales multiples that are reported to be above 90, even over 100 times revenues, far higher than established hyperscalers such as Alphabet or Amazon, despite ongoing losses and projected annual cash burn of $20 to $30 billion. And research such as Morningstar's $63 fair value highlights how much of the growth story is pushed into optimistic 2029 and 2030 scenarios. Elon Musk will retain roughly 84 to 85% voting control after the IPO, supported by SpaceX's move from Delaware to Texas and arbitration provisions that limit shareholder recourse. amplifying key man risk and raising questions for institutions that require stronger governance safeguards. The surge in Musk's net worth, combined with thousands of new millionaires among early employees and investors, is also fueling discussions about wealth concentration and potential future tax or regulatory responses. In the near term, the IPO is pulling capital from elsewhere as some investors sell other equities to fund allocations, contributing to volatility across the space sector and adding to concerns about circular financing as multiple AI and tech firms tap both equity and debt markets. History shows that while most large U.S. tech IPOs close higher on day one, a significant fraction trade below issue price a year later, so the way SpaceX trades after the initial euphoria will influence the broader pipeline for names like OpenAI and Anthropic. Other stock-specific stories underline how governance and AI positioning are being repriced. Adobe delivered strong financial results and a positive outlook, but still saw its shares fall about 4% as both the chief executive and chief financial officer announced departures, prompting downgrades and reminding the market that leadership risk now carries a premium. While upgrades for AMD and expansion plans at Infineon illustrate how clearly articulated AI strategies and policy support can still attract capital even in an increasingly crowded tech landscape. Stepping back, the equity picture is one of powerful earnings and AI-driven growth meeting a macro regime of higher for longer rates, fragile energy relief, and rising fiscal strain. Sector leadership is still dominated by semiconductors and a handful of mega-cap tech names, but small caps, financials, and travel are starting to participate, while SpaceX's landmark IPO concentrates enthusiasm, capital, and governance risk in a single, highly visible vehicle. The balance of risks is shifting toward how bond markets absorb greater supply, whether AI capex remains both fundable and earnings accretive, and how the new wave of mega IPOs trades once the first-day excitement fades. Key signals to watch include central bank communication, oil and refined product prices, semiconductor order books, credit spreads, and the post-listing path of SpaceX and its peers. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.